The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs. Membership is open to senior financial executives including CFOs, financial VPs, and treasurers. We hope that you'll become a member of the Global CFO Council today. To join, please visit the membership tab at globalcfocouncil.com.
Adam, I told you before, you're lucky. Adam Allen. There's approximately 4 million of you, and some of them were super interesting and did some like crazy things, but I don't think they were you. You are the CEO at Anthem Risk. I think you got your undergrad from Columbia Business School in New York and an MBA from the University of Edinburgh.
That's correct.
And now living in Greenville, South Kakalaka. I think you went to high school there as well.
I did. Graduated from Eastside.
That was a bit of social engineering just from the middle of our conversation a second ago. I didn't even know that. But William, hello. How are you doing, sir?
I'm good.
There's not a lot of Williams. And you've spoken before. We had one interesting fact about you doing really well in high school, and you were an SAT scholar. And so I had to go deep cut on you this time. And I got a picture of you if I'm the one sharing my screen. So that's about to come in just a second. You're a partner at RCH Benefits Advisor. I think you got your undergrad from Wofford and your master's in health administration from MUSC. Currently living in Columbia, South Kakalaka, and an adjunct instructor part-time over at the fine university in that great city, University of South Carolina. Is that correct, sir?
That's correct.
I look like this right now. Good hair. I don't like you at all. Married, beautiful lady right there. You look exactly the same. You're taking some sort of serum or you got a good night regimen. I don't know, but you look exactly the same. And then when you were a kid, you look exactly the same. If you're wondering, where did Robert know last time that my favorite book or one of my favorite books was 13 Days? It was from here. And as I mentioned last time, this kid got good grades all from back in the day to the present because he pays attention, he's educated, he reads, and he's going to share that amazing information with us today. Adam, I'm going to chat. I'm going to say, something sort of interesting for the next 30 seconds, and I'm going to let you share your screen. Again, I'm just excited to have you both here. I already have some questions piling up in my inbox about this presentation, so looking forward to what we're about to share. Adam, do you see the little green button to share your screen?
I do. 1 second.
Thank you for being a good sport, William. May I never be the presenter where you are the MC and host. And I'm going deep. If you present again, I'm gonna be showing baby pictures.
Thank you for that. I appreciate it.
Well, let me first start then by saying thank you to Robert. I work with William on a regular basis, almost daily. And so it's helpful for me to have those little things in my back pocket, the research I had not done. So William, I look forward to using that against you in some future meeting myself. In all seriousness, thanks everybody for taking the time this morning to join us. Anthem Risk is an insurance company at heart, and we manage insurance programs for organizations, and so we have some familiarity with what's going on out there. So we wanted to take this opportunity this morning to tell you a little bit about what to expect with your insurance renewals. We know most organizations renew between October 1st and January 1st, and so we thought it was timely for us to tell you what we've seen over the last 6 to 12 months as far as renewals are concerned, and let you know what some options might be if it's a difficult renewal season for you. And even if it's not a difficult renewal season for you, just an opportunity to know what your options are so that looking ahead, as your organization grows, you'll know some other alternative insurance programs or insurance structures that might serve your organization more cost effectively. So without further ado, and since Robert's taken the opportunity to introduce us, I won't spend a lot of time on this. I'll only say about our organization. Our focus, as I mentioned, we do group self-insurance programs. So we are biased in that direction, and you'll hear that as we present some alternatives, and you'll understand why. But we do focus on the nice thing about a group self-insurance program is that our obligation is to the organizations that are insured. So, and you're going to hear me talk ill of commercial insurance. That is not, it absolutely serves a purpose. Our intent today is not to bash them. It is more so to let you know their obligations are to shareholders. No surprise there. They are large organizations. They are publicly traded. So they want to make sure that they are making money for their shareholders. Our obligation as a group self-insurance organization is to the members that we serve. Those insureds, we manage their programs for them. So you'll understand a little further on in the presentation. I will cover the differences, and you'll understand why we believe that's beneficial if you're of a size where that makes sense. But what that does for us is it causes us to focus on trust, transparency, and service. We are completely transparent with how we're pricing things, what their losses are, et cetera. So that's, again, for us, the primary difference. William, I know you've been introduced. Anything you want to add about RCH?
No, just happy to be here. And thank you, Robert, for that. That detective work that you did. I haven't seen that article on me since I was in high school. So no, I'm glad to be here. RCH benefits. We work with a number of organizations across South Carolina, but we also are fortunate to be able to partner with Anti Risk on their medical stop loss captive, which we've seen really take off in South Carolina for the last couple of years. So thank you.
Thank you, William. So let's get to the main information you're here for, the insurance market update. So this is what we're going to cover. As you all know, there are a lot of lines of insurance, and so we're not going to be able to cover every line today. We're a little strapped for time, and quite frankly, we're more familiar with some lines than others. I will tell you that our largest constituency is healthcare organizations, but we do work across industry. We do work in several states. So it does vary a little bit from line to line, industry to industry, state to state. But we thought these are some of the ones that you may be most familiar with and are probably going to have more of an effect. So we're going to first start with a little bit just of an overview. We'll talk about a handful of coverage lines, and then we'll, at the very end of this presentation, we'll go through a list of things that we think you can do to make your renewal as successful as possible. So but you'll see that at the very end of our presentation before we open things up at the end for questions. So generally speaking, the market is hardening. I mean, we have inflation going on, costs are going up, and when you look at two things that really drive cost, one is the cost of property when you have to rebuild things, and healthcare. Healthcare is expensive. It continues to be expensive. So property insurance is, again, our largest coverage, and it's seen the greatest increases. And you see there on the fourth quarter of 2023, it saw another 11% increase. As you'll see in just a moment, that's really being driven by the increase in cost to rebuild things. Medical stop loss rates, and we'll explain a little bit if you're not familiar with medical stop loss insurance. We'll give a little bit of an overview of that shortly. It is also seeing significant increases, and again, as I mentioned earlier, that's primarily being driven by the cost of medical care going up. Auto rates, most of you are insuring autos, that has gone up 8.8% fourth quarter of 2023. Umbrella rates up 6.4%. General liability 5.8%. Workers' comp, as you'll hear again, is really kind of the stable line of coverage. It's basically flat, but there are things that you need to know about it. I'll cover those in just a moment. As I suspect most of you are dealing with a couple of these issues, and we just think there are a couple of things you really need to be aware of. Surprisingly, cyber liability continues to drop, but it's dropping because the carriers are getting better at insuring it. So I'll explain that again in just a minute as well. But cyber liability rates are going down. So property, a couple of slides on property. This is an index to show you the increase in cost of insured values. So as these insurers are having to rebuild things, I mean, that's really what property coverage is. make repairs, rebuild due to damages, inflation is having no surprise here, inflation is having a significant impact on that. Regardless of market, what you see, this particular graph is indexed to 2009, so that would be our baseline. If you look forward to 2023, you can see that it has almost reached the doubling point for property values over that 15 year span. It continues in that direction, although it has slowed, and I'm sure you've all heard that inflation has slowed a bit. The Fed is debating on whether to start lowering rates, so that is slowing a little bit. But as you can also see in the bottom there, regardless of your market, I mean, all those colored lines are all moving in the same direction. Yes, basically expect that your carrier, if they have not done a valuation of your physical property anytime recently, they are going to want to do that. I will tell you that one of the things we most recently looked at was putting together a property captive, because the organizations that we serve are just getting hammered with rate increases. I mean, to the tune of 20+% year over year. We looked at putting together a captive for property coverage. In every single case, regardless of when they had valued it, they wanted to come back out and do a new valuation. And ultimately would not come off of their price. The carriers would not come off of their pricing enough for it to make economical sense for us to create a captive for a layer of that risk. So carriers are it's a very hard market, as we would call it in the insurance industry, for property. Rates are going up, values are going up. So just be prepared for that. This shows how that compares to the rates themselves. You can see back 2017, things were fairly flat. 2019 hits and we start seeing those valuations going up, up, up. And we've had 25 consecutive quarters of increasing property rates. And with no signs of it slowing anytime soon, quite frankly. That's the main thing you need to know going into property. Workers' comp, as I mentioned, it is the kind of the most competitive offering. It remains fairly flat. You might even get a slight decrease if your experience has been pretty good. I mentioned that there are a couple of things that you need to know. You see before COVID and after COVID there, the lighter blue bar being before COVID. This is a graph of how many of the respondents were working from home, or working remotely, I should say. So you can see before COVID, 47%, they never worked from home. They were always in the office. And you see how that has flipped after COVID. In the darker bar, now 44% work from home 5+ days a week. So that is one of the major shifts. And again, I don't think this is really surprising to many of you. I know a lot of you work remotely. I work remotely most of the time now. But it does have an effect. Number one, it does create some discussion around what does that mean from a workers' comp standpoint. If someone is working at home, as I am right now, and I get up from this meeting and I go downstairs to get a cup of coffee, I trip over something, I fall down the stairs, I dislocate my shoulder. Is that a workers' comp claim? And the answer, we handle workers' comp claims all day long. The answer right now is yes. The question that the courts are asking, at least in South Carolina, is if this person had done this, whatever happened in the office, and had gotten injured, would it be a workers' comp claim? So if I was in the office, I was walking to our break room, I tripped over something, I injured my shoulder, going to get coffee, it would be a workers' comp claim, most likely, because it would be something in the office that caused me to have that fall. So they would say, in your home, it's probably compensable too. The difficulty, of course, is in the office, we can control those things. We do risk controls. We see something on the floor, we can move it, we can change it. We know that some of our staff isn't quite so diligent in that respect. The point being here that the courts have taken, at least in South Carolina, a fairly lenient view of what is a compensable workers' comp claim. So you're going to hear more and more discussion around how to manage risk for your work from home employees. That may be a deterrent for some of you. You may look at this and go, well, that makes me not want to let folks work from home. I suspect if you take the time to think about it, that's probably the cost savings of folks working from home significantly more offsets that cost. We see this stuff every day. We manage workers' comp claims. We still allow all of our staff to work from home the majority of the time. We have not seen a major uptick in workers' comp claims, at least with the clients we serve. We just know that it's a risk. So we do have our risk managers. We have risk managers on staff. We have them working with our team, our folks, to educate them on ways to keep their home more safe from injury. So just keep that in mind. The other thing, and I would say this is even honestly probably more important because I think it's a more specific and direct risk to you. For those of you who have remote employees, make sure you're monitoring your new state exposures. As an example, I'm interviewing someone for a position tomorrow who lives in Illinois, and this gentleman would be working for us full-time remotely from Illinois. The thing that you need to understand is that workers' comp is state-driven. Requirements are different from state to state. So if I hire this gentleman from Illinois, I need to know what the workers' comp requirements are in Illinois. Some states have it such that you have to place your workers' comp in their state program. You cannot buy workers' comp anywhere else. Some states have other requirements. You need to, when you're hiring remote employees, make sure you are monitoring where those employees work and what the workers' comp obligations are, because you may think you have them covered under your commercial policy, but you may not. And even if you think you do, and the state regulator may never find out, but if that employee has a claim and they find out that their state has one requirement and you've been insuring them in a different way, the State Department of Insurance can swing a pretty heavy stick sometime with penalties. So be very thoughtful, challenge your HR folks to monitor that, make sure that they're talking to your carrier about those exposures. If you have someone in a state that requires the state plan, make sure that's all being coordinated. So again, workers' comp from a cost standpoint, very competitive. You should have a good renewal. The main thing to do, again, is just be thoughtful about your employees working from home, and also make sure that you're monitoring for your remote employees where they're working. Because as we know, some folks, my company's in South Carolina, I'm working remote so much, I could theoretically live in Charlotte and it would not affect anything. So again, workers' comp, that's kind of where we see things. Cyber, this graph just shows you the average cost of a data breach worldwide. I mean, the trend is obvious. It's going up. These ransomware hackers and others who are gathering this data and holding it hostage are they're realizing the value. They're realizing that people are responding and paying these things. So the cost of data breaches continue to go up. You can see on average now it's about 4.45 million and just continues to creep up. So with that in mind, you might wonder why the cost for cyber is going down. That's because the carriers are getting much better at evaluating cyber risk. They are enforcing risk controls. So when cyber coverage first came out, as it was fairly novel, as many carriers do when they're the early pioneers on a specific line of coverage, they don't necessarily fully understand the risk. They price it very, very expensively, while assuming they are collecting enough money to cover the costs of whatever claims they might have, while they figure out how to manage that risk and how to evaluate that risk. So that's what happened with cyber, but that's been quite some time ago now. They all have very sophisticated risk and technology folks on their teams. They're looking very closely at what you're doing. Your cyber policy is probably going to be a 20-page application with every question under the sun about how you're training your staff and what hardware risk controls you have in place. But the short answer, or the short explanation, is the rates are coming down because they know those who they are insuring are much better risk. So you're going to need to be prepared to make investments. They're going to find holes in your security infrastructure. They're going to find things that have continued to mature from a security standpoint since the last time they reviewed it. There are going to be new tools out there that they're going to want you to have. But in exchange for that, they'll keep your rates down. The ransomware attacks are increasing in frequency. Excuse me. The other takeaway I would say from this, and I'll preface this by saying I came to my organization as the Chief Information Officer, and my role continued to go from there. So, but at the same time, I would suggest to all of you as CFOs to trust but verify with your Chief Information Officer. They're smart folks. They know what they're doing, but technology folks have a tendency to assume because they live in their own heads and they are They are the most typically one of the few folks in their organization who really understand technology and what they do. So they often feel like it's under control, don't worry about it. And because outside folks don't fully understand it, they feel a little uncomfortable pushing back on that. My comment to you is trust but verify. It is worth the money to have an outside organization on a very regular basis, test your security, make recommendations for improvement. And what I've said to our chief information officer is, in doing that, most of the time, those outside organizations are providing support to things that the technology team is already asking for. They do know that some of these things need to be put into place. They know some of those things are disruptive to the organization. It takes, to get these things put in place, it is a little disruptive. It has cost. So it's another way to convince you all as the chief financial officers that this is money worth spending. So just know that that's something that you'll need to do. Trust but verify with your chief information officers and be prepared to make investments. Medical stop loss. Now, before I get into medical stop loss, I'm going to hit pause real quickly. Medical stop loss is a line of coverage that I want to make sure I give a little bit of background on, because it will apply to some of you. It will not apply to others. Medical stop loss is actually, what we typically see in healthcare are medical plans, your employee medical plans, is that I'll say I'll call it smaller organizations that have an employee count of up to about 150. It's right around 150 employees where your medical plan starts to become more cost effective in shifting from a fully insured plan. We're just buying an off the shelf high deductible health plan or a PPO plan from one of the Blues or Aetna or whomever. When you're under about 150 employees, it's better to buy off the shelf because you don't have a large enough employee base or insured base to spread that risk. Once you tip over that, what we typically see is organizations starting to shift towards level funded plans and then ultimately self-funded plans. Medical stop loss is reinsurance for an organization that is has a self-funded plan. So with a self-funded plan, you have a third-party administrator that has a network. They handle all of your claims, but ultimately you're covering all of the costs up to some self-selected deductible. That self-selected deductible is kind of the turning point where it shifts from being your responsibility to your medical stop loss carrier's responsibility. So this is the insurance that sits on top of your medical plan for whatever deductible you choose. In some cases, we see it as small as $40,000. You may want to cover the first $40,000 for everyone on your plan. In some cases, a couple of the clients we have actually have $1 million deductibles. They really are bearing all of the risk for those on their plan, with the exception of those multi-million-dollar claimants. But medical stop loss, for those of you who are in an organization that self-insures your medical plan, medical stop loss continues to increase. That is fairly typical. We see most years stop loss increases anywhere from 5 to 25% increases, just depending on what claims you've had. Sun Life is one of the largest carriers in that market. And so we shared a little bit of their experience and what they saw in 2022, just to give some idea of how things have changed. It used to be very rare to have a $1 million claimant on your plan in a given year. Getting to $1 million in medical care in 1 year used to be difficult, not so much anymore. So you see their highest claims in 2022. They had a newborn that had $6.5 million in care in 1 year. Because of hospital stays, they had comorbidities, high cost drugs involved there. And we can go down the list, but I won't belabor you with all the details. You see even things like cancer now, because of specialty drugs, even a cancer can cost you $4 million. It's not common, but there are those specialty medications. We've all seen the commercials. Some of these medications can drive claims up to significant amounts, even on what we would think to be more common diseases or conditions. And likewise, you see some of those drugs down there. Spinraza, I know you've probably seen those commercials. I know I've seen those a million times for spinal muscular atrophy, cancer. I mean, you can see the annual cost there. Just again, for cancer, it's one of the things that always surprises me, that a cancer annual cost for that drug can be over $800,000, and it's something that can be ongoing if they need that care. And it's not slowing down. You see here the pipeline of specialty pharmaceuticals and gene and cellular therapies, all of these things that medical stop loss carriers are panicked about. You see 2024, that's about 12 billion in sales. And you see that projected forward to just in the next 2 years, that's going to more than double with all of the drugs and therapies that are in the pipeline. Most of that is genetic therapies, gene and cellular therapies, but it's something that this particular issue, gene and cellular therapies, is getting to be such a concern for the medical stop loss market that they're looking at creating a separate insurance line of coverage for that. One of the things you can take away from this is something that we always ask our clients who we provide this coverage for. Spend some time thinking about whether this is a coverage you want to provide. If you, the insurance market is providing this coverage, if you want it now, it is at a premium. They're going to ask at your renewal, do you have gene and cellular therapies? Or they're going to look at your plan to determine if you do. If you do, they're charging more because they know these drugs are something they face or could face. We do have some organizations that just don't provide coverage for genetic and cellular therapies because it is an unusual thing. It becomes a question of, do we want to expose ourselves or are we willing to take this away, recognizing it could be something that could put an employee in a difficult position? They might not have coverage for that, but it is a significant cost driver. So I would encourage you to look at your plan, see if you're providing it. If you don't think you are and you don't want to, be very specific and explicit in making sure that is documented in your plan document, because otherwise it would be assumed that you are providing that coverage if it's not explicit. What's causing a $5 million claim these days? You can see there are three components here. Whether it's a pediatric patient, we see premature babies are very expensive. Long ICU admissions for someone who's going to be in the ICU for a long time, and significant pharmaceutical costs. In 2018, that was almost exclusively driven by either a premature baby or someone who's in ICU for a long time. Pharmacy was only seen in 20% of those $5 million claims. Fast forward to 2020, and you can see how fast this is shifting. Now 50% of all $5 million claims have some high dollar pharmaceutical that's involved. So again, just letting you know that those drugs are going to continue to come into the market, and people are going to use them. I mean, once they've met their out-of-pocket maximum for the year, it's no skin off their nose to go and get the $800,000 drug. They're going to want the best care they can get for their family member. So general market takeaways for now before we talk a little bit about what alternatives there are. Again, just property, expect carrier inspections and revaluations, expect double-digit increases. From workers' comp, again, just be thoughtful about your work from home employees and monitor payroll data for new state exposures. Cyber, be prepared to make those investments and prepare for a ransomware attack. Again, trust but verify with your CIOs. Medical stop loss, again, we're just seeing those $1 million and higher claims being a more common experience. So what are your options? I'll be quick with this just because I think this is a deeper discussion on captives, and if you wanted to get into more details, we're happy to have a separate conversation. There are really three options. One is, there are a million variations on this, but you can buy traditional insurance in the commercial market. If you're a smaller employer, that's almost certainly going to be your way to go. Or you can assume or self-insure some of that risk. You can go it alone, either with no coverage. We have seen some organizations. We just brought in a member that has about almost 10,000 employees that bought no medical stop loss. They insured their medical plan 100% self-insured. They got hit with 3 multi-million-dollar claimants in 1 year, and they changed their position and bought medical stop loss. But you can go no coverage or single parent captive and go it alone, or you can group self-insure, which is what we do at Anthem Risk. So commercial insurance, primary advantage, it's a known cost. They're going to quote you your premium. That's what you're going to pay for the year. If your claims are much higher, you got a bargain. If your claims are much lower, they made their money. Primary disadvantage, it is their market, and you're subject to their needs and preferences. They're going, again, as a reminder, their primary obligation is to their stakeholders. So if they don't want your business, if you're not making them money, they're not going to write your business. If they think you need to implement a risk control in order for it to be for you to be a customer they can make money on, they're going to ask you to implement those risk controls. Role of brokers. I want to be thoughtful here. Brokers serve a great purpose. We use brokers. I think it's important for you to recognize that brokers serve two masters. That sounds terrible, but Not only are they expected to serve your best interests, and they are also they have relationships with all these carriers. They're working with them every day to underwrite and price coverage. Many of them are receiving overrides that you may never see. They may, based on the amount of business they place with a particular carrier, they may not take your program out to renew. Sometimes that's to market for alternative quotes. And to be fair, there's sometimes that makes sense. The market does get tired. If the same client kept coming to us every year wanting us to quote but never really making a change, the market, the carriers get exhausted with that, so they'll just stop quoting. Just recognize that the brokers, in some cases, are being paid a commission off of the premium, so they get paid more just because your costs go up. That is no fault of their own. That's just the way the compensation can be structured. But one of the things we would encourage you to do is look at paying your broker on a fee basis. Almost all brokers are willing to do it. That gives you the opportunity to negotiate what you both believe is a fair compensation for them for the work that they're providing you. So ask your broker, and again, we'll come back to this at the very end, but ask your broker which of your insurance lines is getting paid a commission, how much that commission is, so that you know what you're paying your broker. And if you feel like it's too much, or you just want to go to a fee basis, have that conversation. So very quickly, you can go it alone, no coverage or single parent captive. Advantage there, you have complete control. It's all your money. So you can do whatever you want as long as it's within the Department of Insurance. It's good with the Department of Insurance. Disadvantages is it's very volatile. It's all your experience year to year. So if you have a great year, you saved a ton of money. If you have a terrible year, you're busting the budget. Hidden costs of in-house management. Becoming effectively by going it alone, you're looking at becoming an insurance company or having an insurance company under your management. If you're a jumbo organization, that may make sense. You can have a team that does it. Just be careful because the costs do add up. You've got to have claims folks or a TPA. You've got to have underwriters. You've got actuaries. You've got to have all those things that it takes to run an insurance company. Group self-insurance, we believe this is kind of the sweet spot middle ground. It gives you the cost efficiency and flexibility, but it also gives you risk sharing. You're spreading that risk across a group of organizations that have a similar mindset for group self-insuring. That is primary advantage. Like many things, it's a blessing and a curse. This primary disadvantage is your risk sharing. So if you have a great year, another member has a not so great year, you're helping subsidize them in that year. Rates adjust, you will pay because you subsidize them, your rates should come down a little bit, their rates will go up a little bit. So in the short run, you're sharing that risk. You may subsidize another member to some extent, but the same is true for you in other years. They're going to subsidize you. Nice thing is if you get a large pool, that kind of smooths itself out and doesn't have a significant effect. But group self-insurance is kind of the middle road between the two. Adam, this is a very big, yes.
You skipped Q&A, so I need to hit you with some questions.
I thought we were right after this. Go ahead.
Yeah, let me for time. I'm gonna hit you with some of these questions. And there's like one question per section that you covered. One rapid fire is around on the general. Any big moves by carriers in and out of markets? Are you seeing any carriers? Oh, this one is making some big moves in, or really cutting customers and moving out of markets?
Yes, so anytime there's a hard market, that's where carriers start increasing your retentions, basically reducing the amount of coverage, and sometimes they just don't feel like it's a profitable line anymore. We have seen that with property. We do see some carriers leaving the market on property. I don't know that it'll apply to a lot of the organizations on the line, but if you're a healthcare organization, healthcare professional liability in particular has been really hammered with over the last few years with the liability carriers leaving the market. What most of you would think of as medical malpractice is getting more and more difficult to find coverage for. That's probably true of the liability market in general. I just don't know the details for other industries.
Got a question about the Inflation Reduction Act and its impact on medical stop loss. Do you have any input on that?
I don't. I'm not as familiar with the specifics of that and how it would affect the medical stop loss market.
Cybersecurity question. You talked about an audit and the importance of having conversations with your risk officer. Any thoughts on a standard? If you're going to do an audit, do you like a particular standard, say ISO over NIST? And then also, do you get a discount if you do have an audit and a remediation plan to improve?
So no preferences as far as standards are concerned. My main concern is that you have an outside party do it, a reputable outside party do it. In our experience and what we've seen with the clients that we serve, we've not seen that any of these auditors are using a specific standard or recommend a specific standard, but most of the things that they're doing overlap significantly with a lot of these standards. I certainly wouldn't discourage anyone from pursuing one. I don't think there's necessarily one that's better than the other. As far as the question about discounts, typically, yes, we typically do see, if you've got an audit in hand, that makes the process of your insurance renewal being much smoother. And oftentimes they're much more willing to be more aggressive on price.
When you were talking about workers' comp and having remote workers and mentioned at your firm, you have some, I don't know if it's requirements or standards or suggestions around a safe workplace at home. I got some notes in here about, oh, what's that? What do you have some examples of something that you have on there, suggestions, something to share with us in that area? Because I think we all have
Sure.
one or more remote workers.
Yeah, I can talk to our risk managers back at the office to see if they have specific documentation written up that we can share with the group. But I'll just give a simple example. We had for us as an attempt to get everyone back together on a regular basis, we do a staff luncheon. Again, one of the biggest concerns when you have remote workforces is the damage it might create to your corporate culture, the interaction and the relationships and all those things. So we do regularly scheduled luncheons, and we're a 30-person organization. We're fairly small, so it's easy for us. At our most recent, one of the things we did is we had our risk managers who are certified in ergonomics. We had them set up appointments to go around with our staff and do an ergonomic evaluation of them at their desks in the office and educating them on the things that they need to remember from that and do when they're at home. Our risk managers are available to consult virtually with our staff to make sure that they're getting things set up. So I spent 20 minutes with one of my risk managers, and they're evaluating how I'm sitting, how am I leaning forward or back, where's the position of my monitor, all of those things, again, trying to avoid carpal tunnel. It's the kind of things that we were doing in the office, but now we're trying to train them at least partially so that they have some familiarity with what to do when they get home. Because otherwise they'll get home, they don't even know what, our staff doesn't know what to do. So that's one example we did recently.
I've got better posture just listening to you. Now, speaking of that, when you've got remote workers and you call them in for one of those lunch and learns and to build that culture, when people are in that circumstance, it's a work from home day or they work from home all the time and they're traveling in for something, is that trip a business trip into the office versus commuting for that lunch and learn? And then if they get in an accident, is that a business accident?
That's a great question. Great question. And it is one that comes up and gets debated from time to time. I think the general rule of thumb at this point is two things would be asked about at the event itself. If they had an accident on the way into work, was the meeting mandated? If the meeting was mandated, they have to come in. You as the employer are requiring them to come back. Oftentimes the court would say, they had no choice. You as the employer made this decision. Therefore, it is compensable. And so they would consider that a workers' comp claim. The other is, what were they doing at the time of the accident? So even if you mandated it and they were driving in and they stopped and they said, well, I'm going to stop and I'm going to have some lunch. And their accident was in the parking lot of a Chick-fil-A. We all know how rowdy those Chick-fil-A folks can get. They got in an accident in Chick-fil-A parking lot. They got hurt. Well, now they're on their time because that is not a part of the mandated drive into work. So those are the two primary questions they're going to ask if someone gets hurt driving into the office.
Two more. Adam, how is the cyber insurance evolving for all these financial losses we're all incurring because of email spoofing and the sophisticated email scammers. It used to be a joke, like, haha, so obvious. And I've seen some now at my own firm. Their fake emails and fake marketing materials are better than my own. Like, I would hire them. And so what are you seeing on the cyber insurance side of things because of all that? I gotta imagine claims are up.
Claims are up, but again, the carriers, through their risk analysis at the beginning, they're going to see, but those are going to be some of the questions they ask you. Do you have recurring training of your staff? And and some of you probably use them. There are organizations now that you can engage on a semi-regular basis. They will send those false emails. They will see who's clicking through. They will then give you the information. They will have the training materials so that you can train those folks on what mistake they made, and they don't present it as you made a mistake. But here are some things in this targeted training for folks who are falling prey to that. But as far as claims are concerned, yes, I mean, that's what's driving a lot of these ransomware attacks, and the costs for that are going up. The carriers are still providing coverage for that, but they are just being much more diligent about mandating things because most of the time they get in through your staff, through things like you mentioned. So they're wanting you to have those kinds of tools in place.
Last question for halftime, because we're going very long. For property insurance, is there a replacement value level at which self-insurance with stop loss makes sense in South Carolina, if that impacts your answer?
For property coverage, I mean, most of these carriers will do a high deductible plan, but I don't see, from our own experience, if you try to go to a high deductible plan and self-insure more of that, they're not giving the price breaks they once were. That's what we were trying to do with the captive, is to self-insure for the group the first $1 million in a potential property claim. What we found was that the analysis showed us that if we self-insured that $1 million for the organizations we serve, the number of claims we expected to have did not. There was no savings there. They're not giving the pricing breaks that they once were.
William, Adam, we have left William 15 minutes, so I'm going to be quiet, but y'all pass the torch fast, because instead of 30, you got 15. William,
will do. And so this, I'll end with this. This really just shows you the scale of fully insured to fully self-insured, some of the options there and some of the things to consider. So William, I'll kick it over to you to talk about the stop loss program as a case study for group self-insurance.
Yeah, thank you. So if for many of you, I'm sure that you have probably a January 1st renewal. So this conversation is timely. I'm sure many of you, in your experience working with stop loss in the commercial market, as Adam mentioned, rates are going up every year. So you're seeing, 10 to 20% increases at times on your premium. You're being talked to about things like leverage trend. You're having to increase your deductible to, have a decent renewal, which again transfers more financial liability to your organization. And you're constantly having to shop. So it's a short contract, so it's kind of a short-term approach. I want to contrast that with what we're going to talk about, which is one of Anthem's flagship products, which is medical stop loss captive. Again, the captive is a group self-insurance program. It's been around since 2011. It's governed by the members. There's 17 organizations now in 3 states. Those organizations range from healthcare organizations, car dealerships, cooperatives, municipalities. And really what I think has helped spur the conversation on the captive piece is just a lack of transparency, really in the stop loss arena. So folks, they're paying all this premium. A lot of folks that we come in contact with really don't know how much they're being reimbursed back on the premium. And so that's where a captive can come in handy. It's not uncommon for us to find organizations that may pay $1 million in stop loss premiums a year, but on average, they're only being reimbursed like $400,000 to $500,000 So the rest of that is just carrying profit. So what are some of the advantages of captives? Captives, basically allow you to eliminate carrier profit margins and really retain some of those profit targets and investment income that a lot of the carriers on the commercial side are pricing into your premium. Customization, some captives force you into using specific carriers or TPAs or service providers. But other captives, such as the Anthem captive, allow maximum flexibility at all times. As I mentioned earlier, the commercial market is volatile. Stop loss in general is volatile and it's cyclical. So you're going to have years where your claims are worse than other years. So how do you approach it from the perspective of not being punished punitively, but how what captives do is they can smooth that over time, and then just increase control, but obviously over your coverage, more transparency on an ongoing basis throughout the year of how your program's running, but also having a say in the operations of the program. So some disadvantages to captives. Some captives require a capital buy-in on the front end that's set aside as collateral. And as I mentioned, forced alignment. So some group captives require members to have, the same deductibles with the same anniversary dates. So, and then risk of losses. So again, some captives throughout the year, if the captive is performing poorly, they may institute a capital call or assessment to where you have to come out of pocket. So, not all captives are the same. Again, from Anthem risk perspective, there is no capital requirement to run it. It feels a lot like a commercial reinsurance policy. Anthem doesn't have a fronting carrier, so a lot of captives will partner, with larger commercial carriers to serve as a fronting carrier, and really what that does just adds a little more cost to it. Anthem doesn't have a fronting carrier; they're processing the claims in-house, and they're working with your third-party administrators to work those claims. Captives, again, typically like the commercial market, you're going to pay premium in. If there are any funds left over at the end of the year, they're going to redistribute that in the form of a dividend. With the Anthem program, their clients are only charged what they need to run the program. There's no built-in surplus targets. They really only collect for members what they need to pay claims and run the program. We've been talked about the captives having to use specific TPAs, PBMs, limited choices on deductible renewal dates. The Anthem program allows maximum flexibility. They will work with any TPA, PBM. You can choose any deductible that you want in your plan design, plan anniversary. So it gives you a lot of autonomy and flexibility. I know from my perspective, from a consultant perspective, that's a big plus. So, just at a high level, how does it work? So on the left side, you see here an example and graphic how your commercial reinsurance works. So, for your organization, you have a deductible, and then once that deductible's hit, your commercial stop loss carrier at that point is going to start reimbursing dollars. In the captive insurance model, what we're doing is we're pushing up the attachment point for the commercial. So in Anthem's case, their captive has a $600,000 captive there. That is the portion that is self-insured by all the member organizations. So if you have a $100,000 deductible, Anthem and the captive members cover the next $600,000. So above that, which would be the $700,000 mark, that's when your commercial excess carrier is gonna attach. And so you're pushing up that attachment point, which means that at that point you're really looking at just minimum premium levels. Again, this just reiterates this. so I won't spend too much time on it. But again, this is an example, I believe, someone with a $200,000 deductible level. The captive covers the next 600, and then obviously anything over 800,000 is picked up by excess carrier. I will tell you that not all captives, have the same layer of coverage that they choose. I've seen captive layers as low as 150,000. 250,000 is a top captive layer. So the primary benefits of the program really is to minimize costs and to reduce that volatility. Again, minimizing costs, we talked about, the higher attachment point in the commercial market. Again, we know that most of those claims from a stop loss perspective happen in that $600,000 layer. So, that helps to reduce the profits, and surplus targets, and really the shareholder dividends that are being priced into commercial insurance. As far as the three components in minimizing costs, so members of this captive, they pay three things. They pay their allocated portion of the group's claims, so what's in the captive layer funding. They pay their excess insurance coverage, which is just a standard per employee per month fee, and then they pay their portion of the program's operating expenses. So again, this is just an example. These are real numbers here as far as members within the captive. So again, the actuaries, which AI is the actuaries on this program, they look at how it's running and they come up with their calculation of what the total expected losses are for the program projected for the next year. So client C here in this example is projected to have $500,000 losses, and the total program for this example is projected to have $5 billion. So again, at that point, it's simple math. Client Z's loss allocation is 10%. So what does that mean? That means that they are responsible for 10% of all the claims that are paid within the captive layer. Again, reducing volatility. So Anthem's product looks at 5 years of data. So again, as we talked about earlier, you're going to have bad years. But the difference is on the commercial market, when you have a bad year, you could face a max rated renewal, and sometimes that could be 55%. In the captive model, of the way that this program is structured, you're not penalized punitively for one bad year, and that year will roll off. So in this graphic, basically 2017 is rolling off, 2022 is rolling on. So this member's example, their claims projection would actually be because they have a worse year dropping. So it's a rolling 5 years of data program. Again, a sample invoice. Invoices are paid monthly. Again, the first component is the claims allocation. So each month, the claims that are owed are tallied, and each member's actuarial allocation percentage is applied, and that determines that variable cost. Again, that number can fluctuate. It can also fluctuate if new members join, but that really replaces the large lion's share of your premium. And then you have your administrative expense, which is a fixed cost, and as I mentioned, your excess insurance, which is just a basic per employee per month fee. As far as claim payments, it really is the same as working in the commercial market. Anthem is going to, the TPA is going to file the claim with Anthem. Clients are going to receive their monthly invoices. Once clients pay their invoices, then the program reimburses for any stop loss claims.
Cool. Sorry.
All good. So just a couple more slides here. This is an example of how a $1.7 million heart transplant will work its way through the program. So again, this organization has a deductible of $400,000. The captive then covers the next 600, and then the final 700,000 is reimbursed through an excess commercial reinsurance. Again, just some examples of organizations that we put that we've placed in the program over the last really 18 months. The savings are sizable really because it's not uncommon for us to find these organizations where the stop loss carriers are making large profits over time. And so really that's where the program comes into play and how it adds value, because it cuts all that surplus out of the equation. Is more transparent than the commercial.
Well, thanks, William. And I'll end. This is the last slide for us. We're happy to stay on for questions, but just some quick renewal strategies and tips as you're looking at your renewals coming up. You see there, understand your loss history. Just know your track record. Your broker will help with that, but certainly helpful for you to know what your claims have looked like, especially in areas where you have more frequent claims, like your medical plan, knowing how those things are trending so that you have a better ground to stand on when you're trying to negotiate rates. Budget appropriately. Just make sure that you know if you're self-insuring any of that, make sure you're reserving appropriately and you're evaluating your total costs and managing that on your books. I'm talking to a bunch of CFOs, so that's probably already understood. Shop early and explore non-traditional, non-commercial options. There are options out there, whether it's our captive or another group self-insurance program. Know that they're out there. Take the time to look at them. It can only help you knowing what your alternatives might look like. Be transparent, seek transparency. I mentioned the brokers earlier. Again, I'm not trying to bash them. We work with them. Just know that make sure you know where your costs and risk areas are. Make sure that you have a trusted partnership and that they're being very clear with you about what they make, and make sure that you're finding an organization similarly that will give you your data. I mean, we see a lot of these medical carriers that are unwilling to tell you how your own plan is performing. So seek transparency, trust but verify. This is kind of part and parcel with the previous one. Look for those hidden fees, commissions. Providers are on autopilot. You may have a broker who hasn't is really just kind of letting things renew. Next, determine a safe level of risk. As costs continue to go up, one of the easiest ways to manage that risk is to take a little more yourself, to increase your deductible a little bit. Keep in mind that part of why you're getting an increase each year is because inflation is making your deductible less valuable. Those claims that would not have may have stayed within your deductible level before are now more expensive and are tipping over, and the commercial carriers having to price for that. And then finally, find the right fit. When you're looking for partners, whether it's a carrier or broker or whomever, just make sure you're finding someone who has the same values that you do.
Adam
So
and
we will end there.
That was fantastic. It was 99% educational and awesome. 1% depressing. It is a little depressing, but we got actionable items here. I wrote down to complement this and emphasize this list. Workers' comp, great time to have and make sure you've got strong policies and best practices in that area. Broker, understand the commissions, get a commission statement, consider a fee basis. Gene therapy, I hadn't even thought about, they might carve that out and have exclusions from your core policies. And if they do, you need to understand that and communicate that. That was fantastic. Also, as I think through the decision tree of traditional, self-insured, and captive, I didn't realize some captives like yours do not have a capital requirement. I didn't even know that was a thing. So I circled, not all captives are the same. That was excellent. This is fantastic. If you're thinking, gosh, my broker, I don't have a partner like this bringing this kind of horsepower like Adam and William. I'm going to share Adam and William's contact information, this entire presentation, so that if you've got follow-up questions, if you need to have a quiet conversation with these folks, you'll be able to. So thank you so much, Adam. And thank you, William. This was really fantastic. And thank you all for listening. Give me a like, comment, and a share on LinkedIn about this event. Everybody have a great day.
Thanks, Robert.
Thanks, Rob.
Bye, everyone.